And everybody's looking around you themselves saying, well, what's going to break? When stuff like this happens, the market goes down, something's going to break. We're looking, what bank is it? What hedge fund is it? The actual answer is, it's the economy. The economy has just broken.
U.S. stocks dipped on Monday as the major indexes struggled to maintain the momentum from their surge from the previous week. The Dow Jones Industrial Average rose barely beyond break-even, while the S&P 500 moved up to just 0.1%. Both benchmarks alternated between gains and losses. The Nasdaq Composite decreased by around 0.3%. The actions come after a dramatic recovery on Friday when the S&P 500 rose 3% during the session and nearly 6% for the week overall, marking its second best week of the year and its first weekly increase since late May. However, the benchmark index is on track to have its worst first half since 1970. Macro investor Raoul says that in fact the economy is broken. With the recessionary indicators, along with increased interest rates, we're on the verge of an economic meltdown. Let's listen to Raoul as he gives us his take on exactly why this happened and what he sees in the months to come. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
This is about as macro an environment as I've ever seen. And I think most people's read on it is probably wrong right now. Okay, let's go back and say, I'm going to take you through a history lesson.
Good.
And then we'll get to today.
That's
and
macro.
I'll tell you why I'm concerned.
Yeah.
So why World War II? World War II was a fascinating period because, like COVID, the entire world had basically been stuck at home or been on battlefields. Everyone came back. There was no supply of commodities and goods. Global supply chains were broken, and everybody came back and started consuming again. And guess what? Inflation went up to 13% or something, maybe even higher. That period was fascinating because interest rates went up, and the first thing that happened was the economy went straight back into recession and rates and inflation went negative. Because it was a massive tightening of monetary conditions. You raised the cost of goods on people and didn't raise their salaries enough. People couldn't get the goods that they wanted, exactly like now, and everything collapsed. So we went back into recession, and then eventually some better times. And I'll come back into the 1940s and 50s because I think it's a really important parallel that most people misunderstand. The next time we saw anything remotely like this was 1974. A lot of people tell you it's the 70s again, inflation. Well, the inflation episode we had in the late 70s was driven by demographics. That was the baby boomers entering the workforce all at the same time. It was the largest demand shock the world had ever seen. And we had a supply shock of these oil crisis of the Arab oil embargo. That's not repeating now. What is actually more similar is 1974. 1974 was the Arab oil embargo. The price of oil tripled and interest rates went up. Inflation shot up. And the immediate effect was the economy went down the toilet. Almost do not pass go. The stock market fell 50%. And the ISM survey, which is a good guide to the business cycle, it's the Institute of Supply Managers survey. Anytime it crosses below 50, suggests the economy is getting weak. A recession comes at about 47. It hit 30, which was the lowest in all history. And it happened in a space of 4 months. It went from roughly where it is today, which is around 55, and went to the lowest level in 4 months, based on exactly the same kind of setup we've got now.
So are you saying that the 70s are now pretty close?
Yes, and inflation fell in 1974 afterwards. People are still thinking inflation goes on forever. It did not, and it did not in the 1940s either. Then the next one up is 1984. 1984, we saw an issue where global trade, there was a huge amount of trade disputes. The dollar was pretty strong, like it is now. Interest rates were going up, and inflation was high. And everybody was fearing, looking back and saying, oh, we don't want the early 80s, late 70s again, the inflation. So Volcker was tightening rates too much, and the economy collapsed. It didn't go to recession because the Fed quickly started cutting rates, but the dollar went up a lot more and created a lot more problems. We ended up with the Plaza Accord in 1985 when everybody had to stop the dollar going up from destroying the global economy. So then the next time we see something similar was 2008. 2008, if you remember, the oil price was at $147. Inflation was 6%. The Fed had been cutting into that because the economy was imploding. 2018, exactly the same. Oil prices high, inflation high. The Fed were hiking rates, trying to tighten the balance sheet. And what happened is the economy rolled over really quickly again. Okay, so what's going on here? Why does this phenomena keep happening? Everyone extrapolates inflation out forever. What actually happens is consumption falls because we've tightened monetary conditions. Tightening monetary conditions to ordinary people means the cost of your mortgage has gone up at the fastest pace in history. Over a 1 year period, mortgage rates have never risen this fast. So any money you borrowed has suddenly got much more expensive. Your wages haven't kept up with the cost of just basic services like food. So you're actually feeling poorer. So you can't consume as much and you start not consuming other things. People overextended on housing because they rushed into housing in 2020 and 2021. The rates have gone up for them. Also, just the rise in things like the cost of oil has meant that, gas prices, all of this stuff, and then the rise in the dollar, which is a monetary tightening. All of these things get together would suggest, and I put them on a chart, it suggests that the ISM is going back to 30, which is as it was in 1974, which is a terrifying fall. Now, what
does ISM stand for?
Institute of Supply Management. It's the survey of buyers at corporations who buy goods and services. They ask them, what is your read on the economy? How much inventory have you got? What are prices paid like? That kind of stuff. And they create these surveys, and they're readily available online, and you can have a look at them. And they go up and down with the economy. They tend to lead the economy. And it's suggesting that if we're not careful, we could have a very sharp, nasty recession, meaning kind of a negative 5% GDP recession. It might be short, depending what the Fed does, and we'll come on to that in a bit. So we've got the setup that we've seen many times in the past. We've got the forward-looking indicators, this monetary tightening, suggesting we've got some real pain to come. Then the anecdotal evidence, we're seeing all the tech companies who were bulletproof laying off staff and giving earnings warnings because everybody can't raise prices enough. So their margins are falling and people have overextended. Amazon said, we've hired too many people. They're one of the biggest employers in the United States. Okay, this is not good. But the answer to higher prices is higher prices. And that's what's happened. And everybody's looking around you themselves saying, well, what's going to break? When stuff like this happens, the market goes down, something's going to break. We're looking, what bank is it? What hedge fund is it? The actual answer is, it's the economy. The economy has just broken. And the Fed are going to have to pivot.
The Federal Open Market Committee unanimously opted to raise the target range for the federal funds rate from 1.5% to 1.75%, with more rate hikes appearing imminent in response to the greatest level of inflation in more than 40 years. The Federal Reserve has once again turned up the heat. The 75 basis point increase is the biggest since 1994 and comes after a 50 basis point increase in May of 2022 that was already aggressive. Raoul is confident in the Fed's intention to raise interest rates in order to combat the 40-year high inflation and its effects on bonds, stocks, and the stock market. Now that the financial crisis of 2008 is past, the Federal Reserve expects its policy rate to remain around 2.5% over the long term. The timing of a recession and what the Fed will need to do to prevent the economy from entering a depression will be something we'll be keeping an eye on. What do you think about Raoul Pal's economic outlook for this year? Comment down below. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.